We now know that the real net farm income can fluctuate. It actually peaked in 1973, decreased until 2002, and then started rebounding, especially in 2010. But is the net farm income, whether nominal or real, the only way to measure the financial aspect of a business, of a farm or ranch? Well, no, it's not. Another way, especially as far as the industry goes, that we analyze the farming and ranching sector is by looking at the financial structure of that sector. And the way we analyze the financial structure of that sector, of that farmer ranch industry, is by assessing and examining the major components of a balance sheet. Now, we're not going to talk too terribly much about what a balance sheet is because you're going to get to see it a couple more times while you're here at Casper College. You'll get to see it in accounting, and then you'll get to see it as well in some upper level ag business classes that we teach here at Casper College. And what you need to recognize is that there are three main components of a balance sheet. It's the assets, the liabilities, and the equity. Now the assets, whenever we talk about the assets in terms of a farm or ranch, we're talking about real estate assets, non-real estate assets, and financial assets. So real estate assets might be the land and the buildings. Non-real estate assets might be the equipment that you purchase or the hay that you have left over in the barn. Then also we have these financial assets, which is simply might be the money that you have in the bank or how many stocks or bonds do you have available. You also have liabilities. Liabilities is simply where you owe somebody something. You might owe a certain amount on a loan for your land or for equipment, or you might owe somebody certain money from services that they provided for you. Those are all liabilities. Equity is very simply what is your net worth. After you get done with how many assets you have and what is all of your liabilities, how much are you truly worth at the end of the day? That's your net worth. So, if we're going to calculate equity, because equity is a very important aspect to measure, because it's talking about how much you're worth. Equity is the value of real estate assets, plus the value of non-real estate assets, plus the value of financial assets, minus these liabilities. It's basically saying how much are you worth in assets, minus how much you owe in liabilities, gives you your net worth. That's basically the long and short of it. So, equity shows how much you're worth. But in order to find equity, you have to analyze both your assets and your liabilities. So let's look at the asset trends. What's going on in the agricultural farming sector in terms of assets? And what we notice is that the increase in total value of farm assets. Farm assets are increasing. And they have actually been growing steadily since 1986. And in 2015, the total farm assets, U.S. total farm assets, accounted for $2.9 trillion. That is a large amount of assets that farmers and ranchers within the United States hold. Well, what's causing those assets to rise? Well, have you noticed recently the rising price of real estate? Increasing real estate values are leading to be a major portion of the increase in total farm assets. You see, real estate values have increased steadily since 1978. So if a component of our assets are these real estate assets, and the value of real estate assets keeps increasing, and keeps increasing steadily since 1978, it's driving the total value of farm assets up. And we are currently at 2.9 trillion, at least in 2015. What about liability? What's going on with liability? We see liability has been kind of going up and down, and here recently it's been going more up than down. You see, back in the 1960s, liabilities accounted for $22.4 billion. Remember, your liabilities is what you owe somebody. Maybe it's a loan, maybe it's a payment for services that you've received. But it was $22.4 billion back in 1960. That increased to $188.8 billion in 1984. Since then, that value has fallen from this high point of 188.8 billion in 1984 to 134.3 billion in 1993. Well, let's also look at something. What was going on in the 80s that might have started causing people to basically back off on the amount of money that they were borrowing, this liabilities? During the 1980s, you were having what was known as Reagan's Recession. And it was during a time whenever inflation and interest rates were incredibly high. And actually, many farmers and ranchers had to foreclose on their properties because of the excessively high interest rates. So as they began to foreclose on their properties and they couldn't pay off the notes, they wound up essentially having to go bankrupt and borrowing less. And then after that time, they started borrowing less simply because the interest rates were so high. And that wound up driving down those liabilities until it reached this kind of valley at 134.3 billion in 1993. But since then, interest rates have been relatively low, and we see that liabilities have been on the rise again. And currently our liabilities are at $364.2 billion. And that's of the total U.S. farm liabilities. So, we're seeing that our liabilities, especially here recently, have been going up. But at the same token, so have our assets. So, as the liabilities increase and the assets increase, who's winning out? The liabilities increasing more than the assets, or vice versa? Is equity going up or down? Well, what we're seeing is that the equity trends is that equity in farms is actually increasing. And the reason that it's increasing is that the asset values are greatly exceeding the liability of values from 1960 to 2015. During this time period, the asset values are increasing. And if we look right here, we can see that they're at 2.9 trillion as compared to the liabilities of 364 billion. So we're seeing that equity is increasing in farms, and rather drastically, because the value of assets is increasing more than the value of the liabilities. So another aspect that we need to talk about in terms of financial structure is the debt ratios. So not only are we going to talk about the equity, but we're also going to talk about how does this debt stack up and in what percentage do farmers and ranchers have in debt as compared to, say, how much they have in equity or how much they have in assets. And what we're seeing is that this debt to asset ratio, which means how much debt do they have per asset. And we're seeing that they usually have about 11, or on average they have anywhere from 11.3% debt to their asset ratio, or their debts account for basically 11.3% of the value of their assets to 22.2%. It's ranged anywhere from this 11.3 to 22.2% from 1960 to 2015. But how is it averaged out? We see that it's coming out actually on the low side, and it's averaged out about 12.8% since 2000. What that essentially means is the value of their assets, they usually have about 12.8% of the value of their assets tied up in debt. So that's could be considered a relatively low number. If that number were to reach, say, 50%, if it were to increase to 50%, it means that the industry has half of their assets tied up in debt. If it were to reach over 1%, that means that they would have more debt than what they're worth, or what their value of their assets are worth. Well, what about another debt ratio? What about debt to equity? Now we're comparing how much debt do you have to how much are you worth at the end of the day. And that is ranged anywhere from 12.7% to 28.5% from 1960 to 2015. And since 2000, the year 2000, it's averaged 14.7%. So that's saying that typically you have more debt in terms of equity, or the percentage of the amount of debt you have compared to your equity has been higher than the amount of debt you've had to your assets. What's interesting to note is that both of these values peaked in 1985. And if you remember, that's whenever that liability trend had hit that one little peak before increasing after 1993. So this debt to equity, this debt to asset ratio peaked right after this, basically this peak in loans or liabilities right here.